Marsh McLennan Q2 2026 earnings are out, and revenue hit $7.4 billion for the quarter.
Wow.
Yeah, that is up 6% on a GAAP basis and up 5% organically, or, well, what they call an underlying basis.
Right, the underlying numbers are what we really care about.
Exactly. And adjusted earnings per share came in at $2.96, which is a 9% increase year over year.
That's a huge jump.
It really is. And look, while this particular financial filing doesn't detail the specific Wall Street consensus numbers or, the immediate post-market stock reaction, if you are looking at the fundamental mechanics of a business generating a 9% bottom line earnings jump on just 5% underlying revenue growth is a massive signal.
Oh, absolutely.
I mean, we are looking at a company that is somehow just printing cash by selling advice on how to survive global chaos.
It is, it's basically a clinic in operational efficiency.
Mm-hmm.
And to really frame those numbers, you have to look at the commentary from CEO John Doyle in the release.
What did he say?
Well, he immediately points to the company's execution in and this is a direct quote, dynamic environment.
Right. Dynamic environment.
Which is really just corporate speak for a highly unpredictable, volatile world.
Yeah, it's a nice way of saying everything is on fire.
Exactly. But the reason they were able to wring that much efficiency out of the quarter is due to just broad, sustained demand across their core capabilities. I mean, clients are flooding in for expertise in risk, people strategy, and investments.
Okay, let's unpack this. Because jumping right from a 5% revenue bump to a 9% earnings jump doesn't just happen by magic.
No, it definitely doesn't.
If you're looking at your portfolio right now and you see those numbers, you want to know exactly what is driving that engine. And to do that, we have to look under the hood at the diverging momentum of their two main segments.
Right, because they're performing very differently.
Yeah, when you break down that $7.4 billion, it tells a very specific story about where global corporate demand actually sits today.
You essentially have this massive core business, which is the risk and insurance side, and then you have the consulting segment. And like you said, they are behaving quite differently right now.
Totally. So the risk and insurance services segment is the absolute behemoth here. It brought in $4.8 billion this quarter.
That's a lot of revenue.
It is, but it grew at a relatively steady 3% underlying rate. And just to be clear for anyone tracking the math, when we say underlying rate, we are stripping out the noise.
Right, ignoring the currency stuff.
Exactly. Ignoring currency fluctuations or revenue they simply bought through acquisitions. We are just looking at the organic growth of the business. So 3% organic growth for the core engine.
Which is fine, but not staggering.
Right. But then you look over at the consulting segment, it's much smaller, bringing in $2.6 billion, but it was the undisputed growth engine of the quarter.
Really carried them.
It jumped 8% organically. And when you dig into that consulting number, the divergence gets even sharper.
This is where you see corporate anxiety manifesting in real dollars.
Exactly. Look at Mercer, which handles a lot of human resources and wealth consulting.
Yeah.
It grew 5% overall, led by an 8% boost in its wealth division.
Okay, solid.
But the absolute standout of the entire earnings report is Marsh Management Consulting. That unit surged 13% on an underlying basis to hit exactly $1 billion for the quarter.
$1 billion just in management consulting.
Yeah. It makes me think of, a diversified investment portfolio. You've got this massive, stable core holding that's the risk and insurance business acting as your anchor.
Right, it's dependable.
It's highly dependable, but it's not going to double overnight. And then you have this smaller, high-growth asset in the portfolio, the consulting segment, that is just rapidly outpacing the core and carrying the overall momentum right now.
What's fascinating here is the internal dynamic of that consulting bit, because your portfolio analogy highlights exactly how they are navigating this market.
How so?
Well, if you want to know what CEOs and corporate boards are losing sleep over, look at what they're willing to pay consultants a premium to solve right this second.
Fair point.
Within Mercer, their traditional health advisory business grew at just 3%.
Only 3%.
Yeah, that is utility-like essential HR service. It involves negotiating with health providers, modeling employee premiums, maintaining benefits. It's sticky, it's recurring, but it's lagging behind everything else.
Wait, but if inflation is a persistent factor right now, wouldn't healthcare costs and the desperate need to manage them be rising too? I would expect health advisory to be surging.
You'd think so, but it's really a matter of corporate triage. Overhauling a corporate health plan is a massive, highly disruptive undertaking for a workforce.
Oh, yeah, employees hate that.
Exactly. Unless it's absolutely critical, companies tend to just roll those plans over during periods of high macroeconomic uncertainty. It's not the house on fire problem today.
Oh, I see.
Wealth advisory, on the other hand, was up 8%. And overall management consulting was up a staggering 13%.
Wow.
That tells you that in this specific dynamic environment John Doyle mentioned, clients are aggressively prioritizing capital management, corporate restructuring, and wealth preservation over traditional stable HR services.
So companies aren't worried about optimizing their dental providers. They're hiring management consultants to figure out how to restructure their entire supply chain or survive a capital crunch.
Precisely. Management consulting is discretionary spend. Nobody has to hire a management consultant.
Right, it's totally optional.
The fact that discretionary spend is up 13% means clients are viewing Marsh's strategic advice not as a luxury, but as an absolute necessity. They are paying a massive premium for perspective on how to navigate current market conditions.
But let's pump the brakes on the consulting victory lap for a second. Because while consulting provided that aggressive double-digit growth, the underlying health of Marsh McLennan still relies entirely on that massive risk and insurance segment.
It's the anchor.
Yeah, at $4.8 billion, it is the bedrock of the company. And a 3% growth rate for the core business? I mean, that's fine, but it's not blowing the doors off.
No, it's not.
So to understand that 3% number, we have to look past the top line and analyze geographic performance versus specific business lines.
And you really have to dissect the two main components of that segment. You've got Marsh Risk, which is the primary insurance brokerage, and Guy Carpenter, which handles reinsurance.
Right. So Marsh Risk had a very strong quarter, bringing in $4.1 billion, which is up 4% organically.
Very solid.
And what stands out in the supplemental data is how incredibly balanced that growth was across the globe. You didn't just have one region carrying the weight.
Which is exactly what you want to see.
Yeah. The U.S. and Canada grew by 4%. International grew by 5% overall. And breaking down that international number, you see 5% growth in EMEA, which is Europe, the Middle East, and Africa, 5% growth in Asia-Pacific, and a real standout in Latin America, which grew 8%.
That is geographically firing on all cylinders.
It really is.
And that Latin American figure is particularly notable. It shows high demand for primary risk coverage in emerging markets that are, highly sensitive to global trade fluctuations, supply chain shifts, and currency risks.
But then you look at the other side of the risk segment. Guy Carpenter was the glaring weak spot.
Yeah, that was surprising.
Revenue there actually dropped 2% to $664 million. And that decline was on both a GAAP and an underlying basis. Here's where it gets really interesting.
Okay, let's hear it.
If global risk is rising, which we can clearly see is the case based on that strong international growth, especially that 8% jump in Latin America, why is Guy Carpenter shrinking? Shouldn't demand for reinsurance be through the roof if everyone is trying to offload risk?
That is the critical question when looking at these numbers, and it requires understanding the actual mechanics of how reinsurance works.
Okay, break that down for us.
Think of reinsurance as a shock absorber for the global economy. Primary insurance companies buy it from reinsurers to protect themselves against catastrophic, business-ending losses, like a massive hurricane or a global pandemic.
Right. Insurance for insurance companies.
Exactly. But that market is highly cyclical and extremely sensitive to pricing and capital availability.
Okay, so if the road is getting bumpier, you'd think they'd sell more shock absorbers.
You would, unless the cost to manufacture the shock absorbers suddenly outpaces what buyers are willing to pay.
Ah, I see.
When capital gets tight or when macro risks push the price of reinsurance too high, the buyers just step back. And a 2% decline in Guy Carpenter's revenue doesn't necessarily mean the business is failing or losing market share.
What does it mean then?
Well, in a tough reinsurance market where pricing is irrational or capacity is constrained, the smartest thing a broker can do is step back. You do not want to chase unprofitable volume just to prop up a top-line revenue number.
Are you saying they are intentionally letting revenue slide to protect their profit margins?
I am. And the proof of that discipline is explicitly detailed in the margins. Despite Guy Carpenter's negative top-line growth, the overall risk and insurance segment's adjusted operating margin actually expanded.
Oh, wow.
Yeah, it hit an impressive 35.3% for the quarter. That expansion proves that management is successfully defending the segment's profitability and pricing power. They're extracting more profit out of every single dollar that comes in.
Okay, so they are bleeding a bit of revenue and reinsurance, but still squeezing out a 35% margin on the segment level. That kind of ruthless efficiency begs a bigger question.
Which is?
What are they doing with all the cash that efficiency is generating at the corporate level?
This is where we see the transition from an income statement story to a cash flow and capital allocation story. Because when you manage margins that tightly, you generate a tidal wave of cash.
The consolidated numbers are highly compelling. The consolidated adjusted operating margin came in at 29.3%.
That's fantastic.
When you were running a $7.4 billion quarterly operation at near 30% adjusted margins, you were throwing off a tremendous amount of free cash flow. And in Q2, the company aggressively rewarded retail investors with that cash.
They certainly did.
They repurchased 4.5 million shares of stock for $750 million in the second quarter alone.
Just massive buybacks.
Right. That brings their 6-month buyback total to an astounding $1.5 billion for 8.7 million shares. On top of that, they hiked the quarterly dividend by 10% to almost $1 a share.
Great news if you hold a sock.
But here's the wrinkle. Mixed in with all this massive capital return, the financial filings also detail $58 million in Q2 restructuring costs tied to a program called Thrive.
The juxtaposition of massive share buybacks and a dedicated multi-million-dollar restructuring program is a really fascinating tension to look at.
So what does this all mean? If you're an investor looking at your screen, seeing $1.5 billion in share buybacks looks great on paper. By reducing the total number of shares, you automatically boost that earnings per share number we talked about at the top of the show.
Exactly. It mathematically inflates the EPS.
But you have to ask yourself, are they buying back stock from a position of strength? Or is this just a classic cash cow being milked to mask the fact that they are running out of organic ways to grow? Why are they paying $58 million to restructure while simultaneously dumping cash into buybacks?
If we connect this to the bigger picture, we have to look closely at what the Thrive program actually is designed to achieve. Thrive isn't just a generic cost-cutting exercise where a company blindly slashes headcount to boost short-term earnings.
Okay, so what is it?
It's a structured 3-year initiative. It's focused on brand strategy, aggressive automation, and optimizing their entire global operating model.
Meaning what, practically? Replacing back-office workers with software.
Essentially, yes. It's modernizing the plumbing of the organization. The company is actively noting that this program will generate massive savings from process efficiencies. The $58 million in restructuring costs they are paying today is the strategic price required to protect and expand those 29% margins tomorrow. You mentioned at the top of the show that 9% earnings growth on 5% revenue growth is a massive signal.
Yeah, it's huge leverage.
Thrive is how you manufacture that leverage.
Spending money now to make the operation permanently cheaper to run later.
Exactly. But it's also a highly defensive maneuver. Management is looking at future technological disruptions, things like artificial intelligence, automating traditional consulting tasks, or new digital brokerage platforms entering the market, and they realize they have to modernize their global operating model right now.
You can't just rest on your laurels.
No, you can't maintain a 35% margin in your risk segment if your back-office processes are slow, manual, and outdated. So yes, it's a massive return of capital play for investors, but they are simultaneously funding a deep structural transformation to ensure those cash flows don't get disrupted a decade from now.
That makes perfect sense. The Thrive program is designed to protect margins. But as we dig deeper into the 10Q filing, it becomes abundantly clear that those margins are actively threatened by a heavily risk-laden landscape.
Oh, without a doubt.
The forward-looking statements in this document read like a catalog of global anxieties.
Well, the risk factors section of a 10Q is always written by lawyers to cover literally every possible legal liability. But the specific items management chose to highlight this quarter are very telling about the actual environment they are operating in.
They explicitly name the conflict in the Middle East, the threat of tariffs and shifting trade policies, persistent inflation, and severe capital markets volatility.
Right, because they operate in 130 countries, so every geopolitical tremor hits them.
Technologically, they highlighted the rising prevalence of ransomware and supply chain cyber attacks, as well as the competitive disruption of AI.
Which ties right back to the Thrive program.
Exactly. But there is one risk factor buried in the 6-month noteworthy items that isn't just theoretical boilerplate. It's a massive realized hit to the balance sheet. They reported a $425 million liability and expense for the Greensill litigation.
That green cell line item is a stark reminder of the unique vulnerabilities built into a business model like Marsh's.
I find this darkly ironic. You have a premier risk management and advisory firm, a company whose entire existence is based on helping other corporations identify and mitigate risk.
Right.
And yet here they are, taking a nearly $500 million hit from an unmanaged internal risk tied to litigation. How does the world's top risk advisor get squeezed for $425 million? Like, what actually happened here? Is the shoemaker's children going barefoot?
It's a fair point, and this raises an important question about the sheer nature of the liability a company like Marsh McLennan carries on a daily basis.
Yeah.
They aren't just selling software or consumer widgets.
No, they're in the deep end of finance.
They are acting as a broker and an investment advisor. That means they carry a massive volume of errors and omissions liability, or E&O, as well as fiduciary liability.
And fiduciary liability meaning they are legally obligated to act in the best financial interest of their clients.
Exactly. And to understand the Greensill hit, you have to look at the mechanics of supply chain finance. This is a practice where a financial firm essentially pays a company's suppliers early for a slight discount and then collects the full invoice amount from the company later.
Okay, makes sense so far.
Greensill Capital was a massive firm doing exactly this, packaging these debts into complex, highly leveraged securities. Marsh was involved in brokering the credit insurance that essentially backed these complex financial products.
Ah, so they were the insurance middlemen.
Yes. And when Greensill collapsed in a spectacular fashion a few years ago, the companies and investors left holding the bag didn't just write off the losses.
Right, they don't just walk away. They look for the deepest pockets in the blast radius.
Precisely. Because Marsh brokered the insurance programs tied to these operations, clients looked at who advised them, who placed the policies, and they initiated massive legal action.
It's just a cascade of lawsuits.
It is. The 10Q specifically points out the risk from lawsuits arising from alleged breaches of fiduciary duty or failures to execute timely trades, or even failing to secure confidential client data in the event of a cyber attack. Even if the broker didn't cause the financial collapse, simply being part of the advisory chain exposes them to existential-level lawsuits.
That is terrifying from an operational standpoint. A failure in execution doesn't just mean they lose a client account. It exposes them to nine-figure liabilities.
The $425 million Greensill litigation expense is simply the cost of doing business at this scale. It is the dark side of that 35% margin in the risk segment.
High risk, high reward.
You can charge a premium for your expertise, but you absorb an immense amount of legal and reputational risk to earn it. A single misstep in compliance, a failure to properly disclose a conflict of interest, or just being caught in the blast radius of a failing financial entity instantly triggers these liabilities.
It's a fascinating tightrope they have to walk. On one hand, you are investing heavily in automation and AI through the Thrive program to make your consultants more efficient and boost your margins.
Right.
But on the other hand, if that automated technology hallucinates or makes a critical error in a fiduciary capacity, the legal exposure could instantly wipe out years of those exact efficiency gains.
Which is exactly why the implementation of these technologies in the financial advisory space is moving very carefully. You cannot automate fiduciary trust. The E&O insurance required just to operate as Marsh and McLennan must be absolutely staggering in itself.
It really leaves you with a final paradox to mull over. If you are looking at this stock, the ultimate question is almost a philosophical one about their business model. Here's a company whose entire revenue stream relies on advising corporate clients through global instability, supply chain chaos, and cyber threats.
A world of risks.
In a strange way, do they actually benefit from a chaotic, tariff-heavy, AI-disrupted world because it drives desperate clients into their highly profitable consulting arms? Or will that rising tide of macroeconomic risk eventually overwhelm their own internal operational efficiencies and result in more massive $500 million litigation hits? It's a question of whether the advisor can outrun the very storm they are paid to navigate.
It really is the ultimate test of their own risk management.
And that's all the time we have for today's deep dive. Make sure you follow the show for our daily earnings coverage so you never miss a breakdown of the numbers driving the markets. We'll see you next time.